All right, Pack, welcome back to another video here on the Dividend Doggo Show on YouTube, and I'm bringing you in for the weekly portfolio review, and we are currently on the 22nd of January, so we're about to close the month out. We have one more week for this month, and I'm going to dive straight into the video showing you exactly how my portfolio performed for the week and going over any purchases that I made in the portfolio. So this is a taxable brokerage account on M1 Finance. We're going to just briefly go over the pies here real quick. We have Coma Money, Finance, Consumer Pie, Healthcare, Utilities, Monthly Dividend Stocks, and Industrial and Railroads. So overall, this is what it looks like for the all-time view. We're going to dial this down to the weekly here. As you can see, we were down right around 2% for the week for the total on the portfolio, and no earned dividends for this week. So let's look here and see. It looks like Coma Money was down significantly. Finance was down just a little bit. Consumer Pie was down about 2.35%. Healthcare down 2.6%. Utilities down 2.43%. And then we've got an increase in monthly dividend stocks. We're in the green there by 0.73. And then we've got industrial and railroads down about 1%. So let's do a quick overview of each of these and see how much it was down and what was down the most here. So SCHD was down about 2.5% this week. Berkshire Hathaway down about 2.45%. I'm actually going to be looking to maybe add a little bit more. I'm definitely going to be adding more to SCHG, but Berkshire Hathaway is one of those that I kind of want to build up a little bit further, even though it's not a dividend paying stock in this portfolio. I just think it might be a solid investment for the future, especially with all of the chaos that is to come this year. I just think we're going to have a wild year just like 2022. And then we have finance here. This is a mixed bag for finance because, like you can see here, Bank of OZK was up 3.5%. Bank of America down 3.92%. JP Morgan down 5.5% for the week, which is absolutely wild considering the quality level of JP Morgan would have been my top pick for all of the banks in this particular pie. It's really interesting. I may actually, if it keeps going down, I may end up rotating some of Citigroup over into JP Morgan. Citigroup was up about 2.34%. T Rowe down just 0.59%, and then it's super interesting to me that two of them had really good weeks versus the others. I think this is just off of the earnings. I'll need to double check. I was not paying a whole lot of attention to Mr. Market this week. I did submit a buy order, and I'll show you that in just a moment. But I'm just kind of taking a little bit of a hands off for the market stuff this week. Well, let's be clear, for probably about the month, I'm not really going to be looking too deep at anything or am that concerned about anything. I'm just going to do buys as normal, whether the market's down or up. So let's dive into consumer here. You can see that it's about 2.35% down. That's Altria being down about 1.49%, Home Depot down almost 5%. This is definitely getting into the territory where I'm going to be running and looking and seeing exactly what the point is that I start buying more shares, especially of Lowe's. I really want some more shares of Lowe's. Target down just 1%, PepsiCo down 3%, Costco down 1% for the week. I did a run into Costco yesterday morning while we were running errands. I got 2 chickens, bread. What else did I get? Pancake syrup, because we wanted to do pancake day the Sunday. So it was crazy though. It was like a school bus of kids had been dropped off, and there were kids running around all over Costco. I was absolutely berserk on a Saturday morning. I will try to avoid doing that again. Absolutely bonkers in there. Healthcare, both of these down about 2.7 and 2.6 for AbbVie. Johnson Johnson being down 2.7. I'm excited to see this come down a little bit. I saw PPC Ian was adding more to his Johnson Johnson. I've been looking at when to add for Johnson Johnson for a long time, and I think the appropriate answer is just whenever you can. It's just wild though that it's coming down a little bit, and I'm excited for that. Utilities is Vistra and Duke. This is going to bring us into our first set of buys for the week. It's going to show you both buys at once because I did them both at the same day. But I definitely am holding on my Vistra position until if it drops back down into the low 20s, like sub 20, like 19, somewhere in that range, I would consider buying more. But the debt limit has risen up. I've gotten a few questions about Vistra, and I'm just going to be holding that position for a while unless it comes down significantly. Duke was down about 2.8%. So I went ahead and I did a buy. For Duke here, you can see I bought $590 worth of Duke on the 20th. So that was just a couple days ago. And then UNP was the other buy that I bought a couple more shares of that. So I have had this Duke position for quite some time, and I want to continue to build it up a little bit more. It's not necessarily a great buy right now. I just feel that I want to add a few more shares to it at the beginning of the year this year, and just kind of let it ride. There are likely many other great choices to place that money, including even just throwing it at SPY, but I wanted to build up a few more shares of Duke because basically I've been rolling its dividend into other stocks for a long time now. So wanted to get a couple more shares of that going and kind of move on from there. So monthly dividend stocks was in the green this week. It was up just $60 on the position, 0.73. This is just BST. I plan on holding this for quite some time. I may end up adding a little bit more to BST, but it is now at the point where it's earning about 2 shares per month, which is absolutely fantastic. I plan to continue to compound those shares monthly. It's one of my only dividend payers. I used to have a few more, but I kind of took them out. Then we've got industrial and railroads. You already know that I did some more buying in UNP. I basically doubled the position. I'm going to try to build this up a little bit more. I want to get this to around probably 20-30 shares maybe, and kind of let it just sit and ride for a little while. But Louisiana Pacific Corp is the other stock in here. It was down about 1%. It has come down a bunch since I bought. I believe we're in the red. Yeah, about $125. So it's really not a bunch. It's just a little bit of fluctuation since I purchased it this year. But overall, I'm absolutely loving the market being down a little bit, especially when I'm buying shares. Makes it so you're getting a little bit of a discount on what you're purchasing and kind of going from there. So I just kind of wanted to bring you in for that quick weekly review. I did want to show you one of the main reasons why I'm buying UNP right now. Wanted to bring you over to Qualtrim Insights. This is a tool that you can gain access to through the Joseph Carlson Patreon page. This tool is the tool that he's been working on developing for doing quick glance looks at stocks, and you get these beautiful graphs and a ton of information about the stock and what it's been doing for earnings, what its balance is it net positive or net negative. As you can see, they're very negative. They have a lot of debt. But you can see a couple of things right off the bat, and the reasons that I absolutely love looking at stocks like this is you can quickly take a glance over here at the dividend chart, and this will show you, if I blow this up, this will show you the dividend payouts this is since like 1980, and you can see that it's just gone on this curve since about 2010 and just continued to rocket ship up. And in 2022, it was $1.18 per share. It was 97 cents the year before that, 97 cents the year before that. So they stayed flat for 2 years there, but then it was 88 cents in 2019. And I love seeing a chart like this to just see the growth in the dividend right away. One of the other things that I love looking at when I'm initially glancing at a stock before diving into like the formal SEC filings, the was it 10K and any other prospectus data that they will give you via their site or any other presentation from a quarterly or yearly presentation. I like to know what they've done with their share count. So shares outstanding is a really important metric, and as you can see, back in the 90s, they were still ramping up some shares. They had some decrease and then increase till about 2007. And then we start seeing the share count drop and drop and drop. And it drops significantly. You're talking about, 63,000 shares, just poof, or 63 million shares over the course of like 3 years. And when this goes on the scale and it just keeps continuing to drop, they've almost cut their share count since 2007 or 6 here. We're at about 1 billion shares outstanding, and now we're down to 653 million at 2021. So this does not have the 2022 data in here for the full year. However, that is a really beautiful thing to see the share count decrease like that, because it makes it easier for them to continue to raise the dividend and increase the amount of earnings per share. And that is just really, really good data to be able to look at and see that they've had a consistent track record for about the past 15 years of decreasing their share count outstanding, because it's one of the best ways that a company can return value to you as a shareholder, by decreasing the amount of shares outstanding, which raises your equity stake in the company without you having to add more money to it. So these are a couple of the things that I look at that I really like. One of the big things that I dislike is the debt. So the debt that they've currently got listed here is about $33 billion. They have about a $1.3 billion cushion of cash on hand. This is very, very brutal when you're looking at this. This is the chart of debts and cash. So what we see here is that they have been increasing the debt pretty significantly. Now, what I'm going to be looking for this particular stock for myself is to make sure that they are working on decreasing that in times where the cash is not as cheap for them to borrow. When it's more expensive for them to borrow, what you want to see is the company taking a more conservative stance and not taking out the debt like they were over the course of, you can see here, I'm hovering over 2014 and just going up. You can see that they've raised the debt, they raised the debt, and that's continued to be a trend up until we get all of the 2022 data and see this should likely slow down or stop. Ideally, we want to see this begin to decrease on the outstanding debt as they get a little bit more conservative in the time that we're in right now, where there's some turbulence in the market ahead. We want to see them decrease that debt, and that's going to be one of the key signs that I'm going to be looking for to deploy more capital in this company this year. Is I'm going to be coming in here and I'm going to go to quarterly and see if I can get more data and see, like, are they decreasing debt down? Are they taking out more debt? And then I want to try to figure out what they're taking out more debt for. So that's one thing that I love about real estate investment trusts, is that generally if they're taking out debt or they're diluting you as a shareholder, it's to make a big acquisition or make something that's going to generate more cash flow to their balance sheets. And that's one thing that I absolutely like to see in companies. But right now, over the next year, I'm going to be looking at a lot of the positions in my portfolio to see how they react to the high inflation market, the changes in interest rates, and see if they are working on decreasing the debt sum, or if they're just maintaining their debt load and making their payments as normal, that's okay. But I want to see the companies that I hold hopefully excel beyond that and start decreasing their debt load, especially for ones that have a lot of debt, like UNP. I'm not heavily invested in this company yet, but I'm definitely going to be, that's one of those key factors that I want to see them reduce the debt load before I invest a whole bunch of money into the company. So that's just some insight into what I personally am feeling about the stocks that I'm buying. This is by no means investment advice. You definitely need to do more due diligence on the company to see if it meets the needs for your portfolio and what you need it to do for you over the long run. A lot of the reason why I buy some of the stocks that I buy is the fact that I have a longer term horizon with a relatively stable income currently, with multiple income streams that allow me to, I'll be able to hopefully hold on to the stocks I want to hold on to for between 20 and 50 years. That's the logic in that is that I'm going to at least hold on to the majority of these stocks for 20 years, if not much longer. So buying pieces of infrastructure like Union Pacific Corp is very appealing to me, in that fact that I don't think railroads are going to go around, away at all during my lifetime, probably not during my cousin's lifetime, so on and so forth. So I do want to say thank you very much for watching. I appreciate all of the support, all the new followers to the channel. I appreciate every single one of you. And I will be coming back at you with another video here very soon. So Dividend Doggo signing out.